My name is Andrea Mao. I am the head of our accounting methods practice at Eide Bailly, and I sit in Minneapolis, Minnesota. Maddie Robertson is a senior in our Oklahoma City office, and today we are going to be talking about some of the new developments and hot topics in the area of accounting methods. We've gotten some guidance from the IRS recently, not as much as we would have liked, but we do have some new rules and some new opportunities for folks. So hopefully we'll touch on something today that is of interest to you or your clients. The topics we're going to talk about, as I said, are very wide ranging. We're going to discuss some fixed asset issues, some small taxpayer issues, UNICAP, leasing, RevRec, and then at the very end, a little of reverse methods planning, looking out into the future at the possibility of increasing tax rates. We're going to look at some of the items and issues to keep in mind as that draws closer. And with that, I'm going to turn it over to Maddie to start on the fixed asset opportunities.
Thank you, Andrea. As she said, my name is Maddie Robertson. I'm a tax senior working out of the Oklahoma City office. So today we're going to go over a couple of fixed asset opportunities. So first of all, what has changed recently? The CARES Act issued a technical correction of the recovery period for a qualified improvement property that took it from a 39-year down to a 15-year life. The CARES Act also gave us the ability to modify bonus depreciation elections and elections to be a real estate or farming business, electing to be exempt from 163J. So we can fix these with either 3115s or amended returns. The Consolidated Appropriations Act, that issued a correction of recovery period for pre-2018 residential rental property assets in an electing trade or business. Finally, we also got bonus depreciation regulations recently for the TCJA. So what is qualified improvement property? Qualified improvement property is interior, non-structural improvements to non-residential buildings made by the taxpayer, and they must be placed in service after the building was originally placed in service. The qualified improvement property correction. Qualified improvement property now must be treated as 15-year recovery period with the potential for bonus depreciation. And then these improvements must be made by the taxpayer. So there is no longer any such thing as acquired qualified improvement property. So bonus depreciation modifications. The general rule is that taxpayers are required to claim bonus depreciation on eligible property unless they affirmatively elect out. The election is required to be filed with your tax return for the year the property is placed in service, and it can only be revised with a letter ruling. After the CARES Act, eligible qualified improvement property assets are required to claim bonus depreciation if you do not elect out. The reminder at the bottom of the screen, so qualified improvement property is a separate asset class from other 15-year property for purposes of electing out of bonus depreciation, so make sure you watch that with your elections. RevProc 2020-25, this allowed taxpayers to modify bonus depreciation elections, either make an election or revoke an election with a Form 3115 or an amended return. This is for a limited time only. The Form 3115 must be filed with your 2019 or 2020 tax return, and amended returns must be filed by October 15th of 2021. So we have about 2.5 months left on that one. Modification of real property elections. So taxpayers engaged in farming or real property trades or businesses have the opportunity to elect out of interest expense limitations. If you do elect out, then you must depreciate certain asset categories using the alternative depreciation system, and assets being depreciated with ADS are not eligible for bonus depreciation. These elections must be made with your timely filed tax return, and they are irrevocable. RevProc 2020-22. Those allow taxpayers to either make or revoke elections with amended returns for 2018, 2019, and 2020 tax years. If you do make or revoke these elections, you have to take into account collateral adjustments to taxable income, such as interest expense or depreciation. You can also elect not to use the 50% adjusted taxable income for 2019 or 2020 interest expense calculations, and you can elect to use 2019 adjusted taxable income rather than 2020 adjusted taxable income in your 2020 interest calculation. So residential rental property changes. The CARES Act changed residential rental property from a 40-year life to a 30-year life that was placed in service after 2018. However, the Consolidated Appropriations Act said that all residential rental property must be depreciated over 30 years regardless of when it was placed in service. This only applies to assets using ADS as a result of a 163J election, If you use ADS for tax exempt use property or any other situations, this does not apply. You can make this change from a 40-year life to a 30-year life by filing an automatic Form 3115.
The important thing to remember, sorry, Maddie.
No, that's fine.
About that is the ADS change back in 2018 was made as a change in use. So when you're going back to do the 481A adjustments for those changes, make sure that we're only changing the 2018 and 2019 depreciation. Nothing prior to 2018 needs to be changed. And a lot of our depreciation software seems to be struggling with that whole change in use concept, and then also computing this change. So that's turned into a bit of a headache for people. It's probably the biggest headache we've seen so far with the Consolidated Appropriations Act, at least in getting that implemented. The other development we have had, the final bonus depreciation regulations. So these are the final rules from the IRS on determining which assets are eligible for 100% bonus under the CARES Act. So the wonderful irony of this is that for the most part, these rules apply to assets that were placed in service in 2017 and 2018, and the IRS finally finalized the rules for the 2017 and 18 assets in 2020. Super convenient. So taxpayers are required to follow the final regulations for tax years that begin on or after January 1 of 2021, but they do have the opportunity to go back and retroactively apply them to earlier years to the effective date of the TCJA. And for the most part, these regulations were taxpayer favorable. They largely increased the types of assets that could qualify for 100% bonus depreciation. So for example, they clarified some of the rules around used property. When is a taxpayer considered to have had a prior interest in property such that they can't claim bonus depreciation? There were some changes with the related party and consolidated group transactions. Probably the one we've seen the most was the change for the acquisition date for property that is constructed under a contract with a third party. So a situation where I go out and I hire a contractor to build a building for me. Under the first round of regulations, we would have had to treat that as acquired on the day I signed the contract with the contractor, which for the most part placed them prior to September 27, 2017. Therefore, they got stuck with 50% bonus. Now, under the final rules, we can treat it effectively as self-constructed property. So we look at the costs that are incurred by the contractor that I've hired. And so we can move that acquisition date back, which allowed us to move those assets to 100% bonus if the client is interested. So we haven't filed a ton of these changes, but the ones where we have filed changes, the adjustments have been quite large and quite favorable. So what I tell our clients is, if you have anything that you placed in service in 2017, the end of 2017, 2018, or 2019 and did not take 100% bonus, we should revisit that, because there's a chance that you now qualify to take 100% bonus on those assets based on some of these changes.
So accounting method changes, a few of the changes we had spoken about previously, these are the designated change numbers that would need to be filed on Form 3115. So for qualified improvement property placed in service after 12/31/17, that's a change 244. And if it's placed in service before 1/1/18, it's change 7. Change 245 allows you to make or revoke bonus depreciation elections. 246 is applying final bonus depreciation regulations. And change 88 is the correction of ADS recovery period for residential rental property from 40 to 30 years.
And most of those changes, with the exception of change 88, can actually go on the same physical Form 3115 if you'd like to. And then change 244, 245, and 246 require a little less information than the normal change 7, which is nice. Makes those a little less painful to work through. But yeah, it's still kind of a maze. And we've definitely had situations where clients have had to file 2 or 3 of these changes in order to correct everything that they're wanting to correct.
So now we're going over the TCJA small taxpayer safe harbors. So these are some of the small taxpayer accounting methods. This applies to taxpayers who have an average gross receipts from 2017 to 2019 of less than 26 million per year. So first of all, the cash method expansion. If you are under the 26 million, you are now not required to use accrual, you can use cash basis. Again, accounting for inventories, if you are under 26 million, you can treat inventories as non-incidental materials and supplies. And then under 26 million, you're exempt from UNICAP, and you can also use the small contractor exception for the requirement to use the percentage of completion method. So small taxpayer guidance, the final regulations are finally issued in December of 2020, but they are not published until January 5th of 2021, which means they're effective for tax years beginning on or after January 5th of 2021. If you're a calendar year taxpayer, this does not apply until your 2022 tax year. We are still awaiting some procedural guidance, such as if you lose your status as a small taxpayer, are you required to file a non-automatic method change if you want to switch back in the next 5 years? And then also for the small taxpayer, 26 million safe harbor, you have to follow the aggregation rules. You must aggregate gross receipts of all entities under common control, and you must include pro rata proportions of partnership and S corporation gross receipts in your calculation.
One of the aspects of the small taxpayer rules that caught certainly a lot of our clients by surprise, and I think a lot of taxpayers in general, were the syndicate rules. So under the syndicate rules, a taxpayer, even if their gross receipts are below 26 million, cannot be an eligible small business taxpayer if they are a tax shelter. The definition of a tax shelter, I think we all think about all those people who went to jail for that back in the 90s and early 2000s, but in fact, a tax shelter for this purpose includes a syndicate, which is a situation where more than 35% of the losses are allocated to limited partners or limited entrepreneurs. They have clarified that this only applies in a year that you have a loss. So if your business is always profitable and makes money every year, so you're always allocating income, it doesn't matter how many of the owners are limited. However, once you get to a loss year, then you technically can lose your small taxpayer status because you would be considered a syndicate in that year if you allocated those losses to the non-active members. We were hoping that the IRS was going to give us some relief from these final rules, or from these rules in the final regulations, and bend that definition a bit. However, they declined that opportunity. And the discussions that we have had with IRS and Treasury on this are such that it sounds like they really don't intend to address any of the issues under this provision. Specifically, you would get a lot of questions about, well, what does it mean to be a limited partner or a limited entrepreneur? There is no definition. There is no clear definition in the code, the regs, IRS guidance, anywhere. There were some rules under the farming syndicate standard that were proposed back, I believe, in the early 2000s, late 90s or early 2000s, but then were withdrawn before they were finalized. So there's really no binding guidance there. What we've been telling people, typically looking at, okay, how active, what is their involvement in the business? Is it possible to get them more involved to try to work around this rule? But we're dealing in a lot of gray area with that one, trying to wrap our head around what we need to do to avoid that status. The one nice thing that the IRS did do in the final regulations is provide taxpayers with an election to use your prior year income to determine if you're a syndicate. So for example, if you had a business that had a loss in 2020, you could make an election with the 2020 return to use your 2019 income. So then you'd be allocating income to all of those limited partners and you wouldn't be considered a syndicate. But then in 2021, you can make that decision again. So if 2021 you have income, you can use your 2021 income and you aren't bound by that election to use the prior year income. So effectively what happens is that in order to get kicked out, so to speak, of the small taxpayer status, you need to have 2 consecutive loss years or 2 consecutive years where you're allocating losses to limited partners or limited entrepreneurs. Otherwise, you can typically retain that small taxpayer status.
Okay, so now to small taxpayer inventory safe harbors. You can now deduct inventory when items are used or consumed, and they are considered used or consumed when they are transferred to the customer. You can also follow your applicable financial statements or books and records. You cannot deduct it prior to the time it is deducted in your financial statements, and you also cannot reflect an inventory balance on your financial statements for any purpose. So if you have debt covenants that require inventory on your balance sheet, that, might not work with this. And you also can't put it on there to show investors or any other outside parties. You can keep an internal system to track inventory to when you might need to reorder, but nothing external. And it's also not eligible for de minimis safe harbor. So now I'll hand it over to Andrea if she has any other comments, and also for section 263A.
Perfect. Yeah, unfortunately, this one is an area that, based on the final regulations, very few taxpayers are going to see a lot of benefit here anymore. Many taxpayers had taken the position that if inventory items were classified as non-incidental materials and supplies, they were deducted when used or consumed, which arguably could happen when your raw materials enter the production process. The IRS was fairly clear that they don't agree with that interpretation. In their mind, it isn't deductible until transferred to a customer, which is largely when taxpayers are deducting inventory right now. So outside of a taxpayer without a financial statement that, as Maddie said, is willing to not reflect inventory on there, there's really not a ton of benefit here. Certainly not in accelerating deductions, but perhaps even where there is a potential benefit is in the types of costs that need to be capitalized, but that still likely won't generate a material difference. And so for those clients or those taxpayers who did file a 3115 and write off their inventory, we're anticipating that we will need to file another 3115 to put that inventory back on the balance sheet. That will hopefully be addressed in the forthcoming procedural guidance, how that's going to work. We're hoping that it is a normal method change terms and conditions. So we get a 4-year spread on that amount. It'll be an automatic change, but stay tuned. I'm hoping we get that sooner rather than later, but at this point, I'm starting to think that's likely to be a fourth quarter of calendar 2021 before we actually see anything from the IRS on that. One of the other issues affecting inventory right now are the final 263 Cap A regulations. These were issued actually the end of 2018. The original intention of this project was to address taxpayers who were using negative adjustments to uncapitalized costs effectively. So situations where they were capitalizing costs for book purposes that were not required to be capitalized for tax purposes. And by using a negative absorption ratio and the simplified methods, they were over removing these costs. At least that was the IRS's interpretation of this. I don't know if that's actually what was happening, but that was their interpretation. And so the original focus of this were on those taxpayers, and situations where we often see book costs exceeding tax costs, or situations where the book costs are just greater. So for bonus assets where we take bonus depreciation in year one, we'll have a very favorable book tax difference in year one, but then the remaining years of the life of that asset, we will have more book depreciation than tax because we've taken all the tax depreciation. So therefore, that can result in a negative adjustment that is required. Additionally, some bonus compensation and some of the employee benefit rules are different for book and tax, and some of those deductions can be realized on the book side earlier than they are on the tax side. Another situation we commonly see are where book is capitalizing costs that are not required to be inventoried for tax purposes, specifically pick and pack costs. So these are the costs that occur in a warehouse when you're preparing a specific order for shipment. So when I order from Target a box of cereal and a bottle of Advil, the person that makes sure that the box they send to me contains those two items, that's considered a deductible activity. Which we don't, some taxpayers don't track that for book purposes. And so those are costs that we can pull out on the tax side. And then any 174 research and development expenditures are also not required to be capitalized for tax purposes, even though they might be for book purposes. So that was where the regs started. The IRS was planning to address that issue. They got into it and they ended up adding a lot more detail into these regulations, and even issues were raised in the final regulations that had not been in previous proposed regulations. So this caught a lot of taxpayers by surprise, how much there really was going on here. They provided us a new definition of what they call 471 costs. These are the costs that are typically capitalized for financial statement purposes. And this definition, again, it's only the types of costs. They believe that in most circumstances, taxpayers must use tax basis balances to determine those costs. So for example, depreciation would be a 471 cost because it's a cost that's typically capitalized in financial statements for manufacturers and some resellers. But under the final regulations, the general rule is we would actually have to use our tax depreciation number and not the book depreciation number. So we'd have to go into the book inventory number, figure out how much book depreciation is in there, remove that, and put in our tax depreciation instead, and then figure out what our inventory costs could be, which is an extraordinarily challenging task for many taxpayers, especially the smaller taxpayers who don't have a lot of sophisticated inventory systems or don't have a lot of people focused on inventory on either the book or the tax side. There is an alternative method where we can continue to use our financial statement numbers. However, that only applies if the financial statement is audited. So the irony of this is the circumstance where clients probably have the best information about what's in their book numbers are the situation where they don't have to use those. And this has been quite a challenge for, as I said, some of our clients, and even for some larger clients. This is a very difficult exercise. The other thing that they've clarified is that all direct costs must be included in inventory, regardless of what we're doing on the book side. So we see this occasionally with freight costs, duties, tariffs, etc. Any costs that are incurred in gaining possession of the inventory need to go into our tax inventory number, even if book is not including those. So where we have freight expense, for example, being treated as, a below the line deduction for book purposes or not added into the inventory, we need to adjust that for tax purposes. We can no longer follow what they're doing on the book side. There are also some new rules around allocating book tax differences and variances. So for book purposes, many taxpayers will use a direct labor rate, a direct hour rate. For every hour of direct labor, we'll add $5 of overhead or something like that. But then at the end of the year, you're probably not exactly correct. The actual amount of overhead was probably something other than precisely $5. And so these regulations talk about how do we handle those variances, what's happening on the book side, what do we need to do on the tax side. And then there are also some limitations on how we remove those costs when they're in the book number, but we don't want them in there for tax purposes. Probably certainly the most favorable component of this for some clients, and probably the piece of this that has gotten the most attention, is the new modified simplified production method. So the simplified production method is what we would use for a lot of our clients who are in manufacturing to determine the 263A costs included in ending inventory. It was a very simple ratio, production costs over inventory, and very manageable for taxpayers. Well, under the new guidance, there is a new modified simplified production method that splits that production absorption ratio into two. We have a pre-production and a production absorption ratio. And the pre-production absorption ratio is applied only to our raw materials. And then the production costs are applied only to WIP and finished goods. So we don't have to capitalize any of those production costs into our raw materials. This is required for taxpayers who have more than 50 million in average gross receipts that want to continue to treat the negative adjustments, so the removal of those book costs as additional 263A costs. But what we have found is that of the clients who have looked at this, taxpayers that have a large raw materials balance are actually better off under this modified simplified production method. And we've been able to generate some savings for some of our clients. Again, going back to the fact that if I have a large raw materials balance, in the past, I would have had to use an absorption ratio that included both raw materials costs and production costs, and apply those production costs into my raw material, even though my raw material hasn't gone through any of that production activity yet. So under these rules, what we can do is we can carve out the costs that relate to acquiring and storing raw materials, apply those to the raw materials only. That's all we need to apply to the raw materials. The raw materials don't get any of the burden or production costs added in. So it has been a favorable change for some of the clients who didn't have to, just chose to do this. And this is also, shockingly, a 3115. This is considered a change in accounting method. It is an automatic change. The IRS waived the 5-year limitation for tax year, the first, second, or third tax year ending after November of 2018, so that it would be tax years ending December of 18 to 19 and 20. And the main benefit of that waiver is if the taxpayer has filed a UNICAP change in the prior 5 years, typically they are restricted from filing an automatic change again, even though the IRS changed the rules. So we need to use that window, so to speak, of the waiver of those requirements to make those changes. Taxpayers that have not made a 263A change in the last 5 years don't necessarily need to worry about that. So this is something that if this, if not addressed for 2021, it isn't necessarily the end of the line. There are opportunities to do this in the future. There are just some potential concerns with prior UNICAP changes that have been filed. Our next topic, leasing. So why? Why are we talking about this today? Well, in a refreshing turn of events, it's not because there has been a change in the tax law. There has not been a change in the tax law regarding leases. However, there has been a change in the GAAP standard for leases. Topic ASC 842, it was effective for publicly traded taxpayers in prior years, but will apply to non-publicly traded taxpayers in the current year. And that process, the process of implementing that standard on the GAAP side, from what I have heard from my audit brethren, is that they are going to be required to review and analyze the terms of all of their lease agreements to determine what needs to be booked on as additional assets and liabilities on the financial statements. So that is helpful to us because they are doing the work to gather all of these lease agreements, summarize the terms, and it's a good opportunity for us to jump in there and look at what is going on with these leases on the tax side. A lot of the rules for GAAP and tax are different around leases. And so we often see Schedule M adjustments for taxpayers that have significant leasing activities, either as a lessor or a lessee. And so this is a good opportunity to dig in and make sure that we have all of those adjustments working correctly. And the reason for some of the confusion here is really, it starts at the very beginning in how we refer to these things. GAAP uses very different terminology than tax does. GAAP will refer to things as operating leases and capital leases, whereas in the tax world, there's really only one kind of lease. It is a true lease. It is a situation where the lessor owns the property and the lessee has a right to use of the property. For things that GAAP refers to as capital or finance leases are perhaps in the tax world not leases at all. They're considered sales of the underlying property, financing transactions related to the underlying property. They are not actually leases. So when an auditor comes to you and says, hey, I've got a new capital lease, we've got to be thinking, I don't know if that's a lease. You can use the word lease if you want to, but we need to do some investigation to see if lease is even the proper term to use for that for tax purposes. And the tax analysis also operates quite a bit differently than the GAAP analysis. My understanding of the GAAP analysis for these leases is that there are a series of tests that need to be applied, and if a lease fails or passes one of those tests, it is classified one way and that's it. There's no further analysis required. Whereas on the tax side, this is a very facts and circumstances heavy analysis. We don't have those nice bright line tests. We have to be looking at all of the considerations around the leases. What are the terms? What is actually in this lease? We can't just get to question 2, say, yep, that's capital under that rule, and stop our analysis. If there's one of the 5 criteria or one of 6 criteria that go one way and all the other criteria are pointing in the opposite direction, doesn't necessarily mean that we go the opposite direction. We need to weigh these against each other and make sure we understand all of the components of the leases and are properly taking into account all of the relevant facts. The key criteria for tax purposes in distinguishing between leases and non-leases is which party has the benefits and burdens of ownership of the property. This is based on the economics of the transaction, which party has the ability to profit or the risk of losing money on the transaction. Effectively, this is, the IRS is trying to make sure that the tax rules follow the economics. So if if it is a transaction where the lessor retains the economics, so they retain the ability to use the whatever residual value is at the end belongs to them. Then if there's a significant amount of residual value left, that's a very significant economic interest in the property that the lessor is retaining, and that could be considered, that could mean that the transaction is a tax lease. If those benefits and burdens of ownership are transferred to the lessee, we would consider that to be a sale of the asset, typically at the outset of the lease. And the big issue here is the accounting for leases involve a number, it's not just one line on the income statement, because whoever owns the property gets the depreciation, and whoever is using, if they're using the property, those payments, either they're 100% deductible rent or there's some combination of principal and deductible interest. So unfortunately, missing the classification on one of these leases, again, especially when we're living in an era of 100% bonus for a lot of equipment assets, can be a huge difference in the tax consequences as to which party gets that bonus depreciation. And occasionally you will see in the lease agreement that the parties have agreed that one or the other will be considered the owner and will be entitled to the depreciation. Those are very helpful, but we need to make sure those are also reflective of the underlying transactions and that they are being handled correctly. Because one of the big differences between GAAP and tax is that from a tax perspective, the IRS's view is only one of these two parties gets to take depreciation. We can't both depreciate this asset. Whereas on the GAAP side, they're less concerned. If it happens, the asset shows up on the financials on the balance sheet for both companies, they don't necessarily care. The IRS definitely cares. And so what we found actually more frequently than I would have anticipated, we find our clients' leases contain something indicating that they have agreed which party is going to be taking the depreciation, because again, the very valuable tax attribute at this point in time and probably impacts what the parties are willing to do and how much they're willing to pay for those transactions. So what happens if we find out that the transaction has been classified incorrectly? There is an automatic accounting method change that now allows a 481A adjustment. That change has been around for a long time. It was just in 2019 in the automatic change Rev Proc 2019-43 that they finally allowed a 481A adjustment, which is huge because, as I said, taking the depreciation or giving back the depreciation is a very significant tax cost of reclassifying a lease. And if a 481A adjustment in this context is more than just, as I said, one line item, we've got to make sure we're accounting for all of the components of the transaction that are changing. So reclassifying a payment from rent income to, part sale, part gain on sale, and part basis return, part interest income. We have to take that into account. We've got to figure out what was the gain or loss on the sale. If the party's considered to have sold the asset, then they should have a gain or loss that needs to come into that transaction as well. And as I said, the IRS has a vested interest in making sure that at least that they aren't getting whipsawed by taxpayers. They don't have situations where you have two taxpayers depreciating the same asset. So it is a requirement to attach a list of counterparties to the leases that are being changed. I have not had the IRS ever ask much beyond that, and I have not heard any stories of people who got picked up for exam because someone that they were in a lease agreement with put their name down on a 3115. It's not that, but I think the theory there is that if the IRS were to want to pursue that, if they became concerned about how a party was treating leases, that would help them know who's on the other side of this and making sure they aren't getting whipsawed. The interesting component of this automatic change, typically an accounting method change, provides us with what they call audit protection. meaning that the IRS is not allowed to change our treatment of that asset for any time prior to when we're filing the 3115. So that way, it's a great incentive for taxpayers to change their methods because they don't have to worry that the IRS is going to come back and audit them for that once they've requested the method change. However, the IRS is not providing audit protection for this change. And we have asked why and have never gotten a great answer from them on why this specific issue is so troublesome to them that they are not willing to provide audit protection, but they don't. So that is also something to keep in mind as we are making these changes, is that it isn't necessarily a quote unquote get out of jail free card the way it might be for other issues. Another issue we've seen more of in the last year related to leases are Section 467 rental agreements. And these are leases that include increasing or decreasing rents or deferred or prepaid rents. So situations where a lease, would start with it is $1,000 per square foot in year one, increasing by 3% each year for the next 5 years, or the opposite, it's $1,000 per square foot in year one, and it goes down by 3% each year. Those are those agreements that have increasing or decreasing rents. GAAP often will straight line the rent over the term of the lease. They'll sit down and say, okay, it's a 10-year lease. I'm going to start at 1,000, and by the end of 10 years, I'll be at whatever 3% per year is on top of that. So I'll know my total payments for 10 years. I'm going to take 10% of that total each year, even though in the early years, that's going to be more than I'm paying. And in the later years, it's going to be less than I am paying. Generally, that's not the correct answer on the tax side. It can be in some circumstances, but in many cases, in most cases, in fact, we will follow the payment schedule in the lease agreement. So our rent income or expense is going to follow the money effectively. It's going to follow the cash between the lessor and the lessee for the use of the property. And so we should have a book tax difference for the deferred, for an increasing or decreasing rent. Deferred rent, that can occur where there is a rent holiday at the beginning of a lease. That's not uncommon to give 1 month free or 6 months free or 1 year free. Again, what book is probably going to do is straight line the rent over that so that there is some rent that is being allocated to that quote rent free period. And then prepaid rent is the opposite. The rent is front loaded at the beginning of the lease. So the cash is getting paid up front. And then later on in the lease, there is very little, if any, cash being paid. Sometimes the 467 rules will force us to account for an interest component where that rent is significantly deferred or prepaid. The good news is that the deferral or prepay period needs to be fairly large or fairly long in order to get caught by those rules. But if we do get caught by them, they're ugly. That's a really painful calculation to put together where you have to accrue the interest and find net present values. And it's a lot of fun with Excel when it does kick in. But if we find, the nice thing about this though, is that if we do identify an issue with a lease, we're following book, we're not making a book tax adjustment for some of these things, it is an automatic accounting method change for us to make that correction. And as with everything else, COVID made a difference. Under the 467 rules, you have to perform the 467 analysis at the outset of the lease, so the beginning of the lease, but then anytime the lease is modified, it needs to be reanalyzed to see if 467 could apply. Some of the modifications we have been seeing in our clients' leases can cause 467 issues. For example, a lessor may have said, for example, from a mall, the stores were closed. Most of the malls were closed from March through probably June or July. And so the landlord could have said, you know what, we're just going to forgive the rent for these 4 months. You don't have to pay anything. And then we'll go back to paying normal rent again in September. Well, again, that's effectively going to create a rent holiday. So then the question becomes, well, what's happening then on the book side with that? Are they going to straight line rent during that period? Are they really going to show no rent during that period? What are they doing? Again, with a holiday of that length, it's probably not going to force a tax lease into straight line accrual, but it is something that would need to be tested. I think the more challenging situation is a situation where the lease explicitly defers the payment of the rent. And this is a situation where the rent is allocated to a different period than it is payable. And I had not seen an agreement that explicitly did that until last year, and then I saw a bunch of them. So what a lease that does that might say is that, okay, so your rent from March to September, we'll say, it's $1,000 a month. So we're gonna take the rent that's accruing in March, April, May, June, etc., and we're gonna make that payable in 2021. So we're not forgiving that rent. You still have to pay that rent. And because that rent relates to 2020, you have a fixed legal obligation to pay it. And I think that's part of the reason that they chose to do it this way rather than just saying, oh, forget about it for now and we'll increase your rent later. This at least saved the landlord's claim for this rental income for those periods in the event that something went south with the tenant. They at least were in line with this fixed amount owed from the tenant. So in those situations, that can cause a significant problem, especially when you're looking at a deferral that was in excess of a year in some cases. Because yeah, a lot of those businesses that shut down in March of 2020 may or may not even be back up to full strength now. So some of those some of those deferrals are still in place, meaning that there are still some tax consequences that we need to be looking at because that can be a very, very unpleasant surprise if that happens. Revenue recognition, this is another issue that sort of partially started with GAAP, partially started with the TCJA. ASC 606, which is now effective for everybody, for public and non-public taxpayers. And it is a new revenue recognition model based on a principles-based approach that changed how revenue is recognized in financial statements for all GAAP basis taxpayers. 451B was part of the TCJA. The intention of this was to target those clients who were reporting income on their audited financial statements, but not on their tax return. The IRS was a little irritated with all of these businesses that were showing these great earnings to the SEC on their financial statements, and then when it came down to their tax returns, like, where did all that income go? Well, the intention of this provision was to accelerate the recognition of income to match book, but it only applies to taxpayers that have either an audited financial statement or they're subject to state or regulatory filing requirements, which unfortunately catches a lot of banks and actually can catch some construction companies. Those who have, based on their contracts with the state or federal government, have some regulatory filing requirements can get caught by that. And that is always going to be an unfavorable answer because there is no way that 451B will ever do anything other than accelerate the recognition of income. 451C, this was the codification of a rule that had been out there for quite a while regarding the treatment of advance payments. So situations where the client collects cash and provides goods or services in a later period. This is common, for example, for software licenses where the entire fee is paid up front, or perhaps entire fees for certain services get paid up front. The entire cost of goods gets paid up front. And that's actually one of the most significant issues that we have seen come up related to the revenue recognition standard is the treatment of those advance payments. Those could be showing up on the financial statements as a deferred revenue, under income, could be called an advance payment or a deposit. And this is a significant source of book tax nonconformity. Typically on financial statements, taxpayers or clients will recognize that as it's earned, and it could sit there for years. If you get a prepayment for a 10-year contract, it can sit on and be recognized ratably over 10 years into your financial statements. The IRS views those very differently. In the IRS's world, once you've collected the cash, you have the ability to pay them. And once you have the ability to pay them, you should pay them. You don't get to defer this. And so on the tax side, the best we can do is a 1-year deferral. Prior to this, as I said, this was the rule under 2004-34. Prior to the TCJA, there were a few theories that could have gotten longer. deferral. 451-5 could have given a 2-year deferral for the sale of goods. There were some case law around actually baseball and utilities, of all things. But the IRS's opinion in following the TCJA is that those rules and those opportunities are effectively gone. So in that situation where the client is spreading that income over 10 years, we can follow book in year 1, either to the extent it is recognized in our financial statements or it is earned. We pick up that piece in year 1, everything else comes in year 2. So we don't get the benefit of matching this against the future costs or future activities because we have collected the cash. Other, some of the arrangements that we've seen that were impacted by ASC 606 that caused a change on the tax side were in several common industries. Franchisors was one of them. This is actually a situation where the advance payment rules come into play because the franchise fee may be received in bulk upfront, or at least several years of it may be received upfront. And for GAAP purposes, they now view that as an obligation that is earned over the entire term of the franchise, meaning that if I have a 10-year franchise agreement, I have 10 years to recognize that fee and income for book purposes. But since I've collected it, for tax purposes, I have no choice but to pick that all up by the end of year 2. So there was some unfortunate changes there. Also, they reanalyzed some of the costs related with franchises and other agreements and said, commissions that are paid to salespeople or people who are generating these franchises typically relate to the underlying 10-year franchise. And so instead of deducting that commission expense in year 1 when you paid it, for GAAP purposes, they are now capitalizing and amortizing that over the term of the agreement, which unfortunately we also need to do on the tax side. So we saw some unfavorable changes there. Bill and hold arrangements, these are situations where you sell goods to a customer and then put them in a warehouse and tell the customer that they're available to them whenever they want to come pick it up. In that circumstance, what the new ASC 606 rules are saying is that when you transfer that to the customer and tell them it's ready for them to pick up, you've satisfied all of your obligations. And so you recognize that revenue on that day, not the day the customer picks it up, the day you set it out there to be available to them. So this is also an unfortunate circumstance because we are having to accelerate that revenue for tax purposes, subject to 451B, because we've picked up that revenue for book purposes. Books may also be accelerating the deduction of the cost of sales to match that revenue. We may or may not be able to do that on the tax side. We need to get a better understanding of the ownership of those goods. We may end up in a situation on the tax side where we have to increase income, but then defer the offsetting cost of goods sold. And then the last area we saw some of our multi-year service contracts. So again, this is software license where year 1 is $100,000, year 2 is $150,000, year 3 is $200,000. For GAAP purposes, they may now take that as one 36-month contract and straight line that revenue over 36 months, which again, if we're subject to 451B, can get us an unfortunate result because in those situations, the amount of rent, in those earlier years is going to exceed the actual cash collected, and then in the later years we'll get to the opposite situation. But unfortunately, that was another result of that guidance. And now I'm going to turn it back over to Maddie to talk about looking into our crystal ball about the next couple years in the methods world.
Thanks, Andrea. Yeah, so reverse method planning, a little bit different than what we usually do. So in this kind of situation where we're expecting tax rates to rise over the next few years, we're now looking to accelerate revenue or defer deductions, which is a little bit different than what we're normally doing. So there's a few ways that you can do this, either through elections, accounting methods, or a change in facts. Some of the elections that we could do, you could either elect out of bonus depreciation, and that pushes your depreciation deduction into later years. You can also choose not to make de minimis safe harbor elections and capitalize all of your fixed asset additions. Some of the accounting method changes we've seen is you can move to a less favorable inventory method or move to full inclusion method for advance payments. So like Andrea was saying earlier, instead of using the deferral method and picking up most of it in year 2, you can instead choose to include it all in year 1, maybe recognize it now and then when rates are still lower. You can also do a change in facts, modify your employee bonus plans to not fix the liability until after year end, or do not pay year-end compensation with 2.5 months. Again, that pushes it into the next year. Some considerations to take into account. So for an accounting method change, you are required to treat it consistently in future years if you change. And then also if you change it and then later decide that you want to change back to a more favorable method, that may not be an automatic method change. Non-automatic method changes have a filing fee of about $11,000, so that is an expensive fix if you want to do that. For elections, they can be either annual or irrevocable, and they can be costly to modify in future years. For the change in facts, it can have significant administrative costs and an impact on your business practices. You might have to amend documents to not fix those liabilities like we were talking about, or to pay them out later. And then these are some of the common automatic changes we're seeing recently: prepaid expenses, depreciation, and then depreciation in relation to cost segregation, software development costs, UNICAP, deferred revenue and advance payments, and then state taxes and self-insured liabilities.
Yeah, and Maddie, as you said, the interesting problem with these changes, with the accounting method changes, is an unfavorable adjustment is required to be spread over 4 years. So I've already gotten questions from people that are saying, hey, can I pick up this entire adjustment in 2020 or in 2021? Because I know what my tax rate is now. I don't know what my tax rate will be by the end of this 4-year period. And the general rule, unless the 481A adjustment is less than $50,000, we have no choice but to spread it over 4 years, which is another issue with trying to use accounting methods planning to manage the to manage taxable income, because it's not as easy as deciding which year it goes in. It may end up getting spread to a later year that people are not planning on. And there are also some aspects of the tangible property regulations. I think people don't often realize how much flexibility there is in some of these methods. For example, under the tangible property regulations, you can make a de minimis election to follow, to deduct everything that's deducted for book, which is good. But if you don't make that, then that means you can start capitalizing your $50 staplers and your $200 copiers and printers and things, which will generate, if we elect out of bonus depreciation for those, that at least spreads that deduction out to later years. You can also make an election to capitalize all of the repairs that are being capitalized for book purposes. Since book typically capitalizes more than tax does, that is an opportunity to start capitalizing all of those roof repairs, driveway repairs that we were all so excited to deduct back in 2014 when we implemented those regs. Well, now we can consider maybe we don't want to do that anymore. Maybe it does make sense to push some of these things back. And if you're in a situation where you're looking at, one of the any of the topics we discussed earlier today, whether it's revenue recognition or inventory or UNICAP, any of those issues that could generate an unfavorable adjustment for a taxpayer, maybe it is worth thinking about doing that in 2020, even if they don't have to. Even if we could put off paying this tax for a couple years, maybe it should be done now. Maybe the taxpayer, based on their current earnings or based on their planning, they're better off adopting some of those rules earlier than they have to. We've had calls with a number of taxpayers trying to think through, okay, what is my total cost if I did this in 2020? What would it look like if I did this in 2021? Based on changes in inventory balances and things, because we also saw, depending on your industry, a number of taxpayers had a very, very low ending inventory at the end of 2020 due to some supply chain and other COVID-related problems. And making any inventory changes will generate a lower 481A adjustment, typically in a year where your inventory is low. So filing, if you went into 2021 with a very low inventory number, there may be a reason to try to do an unfavorable change in 2020 versus 2021, because the unfavorable change again gets our 4-year spread if we want the 4-year spread. Or we may be better off doing it in 2021 if the inventory balance is low. So there are a lot of variables that can come into play in thinking these things through. And of course, this is all contingent on the fact that nobody knows what is coming down the road. I think a lot of people expect there will be higher tax rates, but for which taxpayers and how much remains to be seen. So we tell people, don't be careful with what you're doing now, because like Maddie referred to with the elections, that might seem like a great idea today. If it turns out 6 months, a year from now, it wasn't a great idea, there's going to be really difficult to undo. You're going to be stuck with it. So think very, very carefully before taking these actions. And, as one of my colleagues pointed out to me, he said, at this point, I think I'm just going to start telling my clients to extend 2021. I'm going to start now and start telling them now that we're going to be extending 2021 so we can get as much information as possible in before we decide what we want to do on those returns, because these automatic changes can go with a return prior to the extended deadline. So we still have time for 2020 to do these. They could go with a return that's already been filed. We can amend the return and attach the 3115. We could file them today for 2021, start the audit protection, help the client start thinking through some of these things. So many, many variables in the tax accounting world. And you'll probably, the next time you hear from us, maybe we'll have some more concrete answers for you on either some of this guidance we're waiting on, what these rates look like, maybe some new planning strategies, because the bipartisan infrastructure bill that draft was released yesterday, I think, or today. There's already things in there that people are starting to think about with energy credits and some cryptocurrency issues. So stay tuned. Who thought accounting methods was going to be the exciting place to be, huh?